Okay. I'd like to welcome us all. I'd like to welcome us all to this webinar session. Do we give our African brothers about 15 more minutes, or do we start straight ahead?
I think we should start so we can keep in time. So
okay.
I think we should start. Yeah.
Hello, good afternoon, everyone. My name is Akuma. I'm a financial analyst, and I'm a member of EAYF Foundation. It's a youth platform, basically. Here's this short video as an introduction to our NGO. NGO.
Oh, let me do it. Joel.
Yeah, please. Okay. Yeah, here this short introductory video of our organization. We are just here to connect the African youth, basically for productivity, self-empowerment, and basically, taking the African youth forward. We support each other we support each other in any way we can, from businesses to personal development, financial development, and many more packages we have for our members. So I'll be kicking off the webinar. Which is basically to introduce startups to accounting and finance, how startups can understand financial reporting. And our first speaker, who is a very brilliant accountant, all the way from the US, Ifenlota Apakama. She's a graduate of University of Ghana, a first-class accounting graduate for that matter. And she's presently doing her MSc in Holt International Business School. She has had some experience under her belt. Basically, other than her bio being there, Ife is a very brilliant person, and I'm very happy she took it as an honor to take this webinar for us today, and I'm very honored, Ife. Thank you and welcome.
Thank you.
Yeah. And our second speaker, Nicholas Nguyen. Our second speaker, Nicholas, the graduate of Magna Cum Laude University, a finance graduate, brilliant associate himself. And he's taking the second part of the lecture, covering the financial statements for us. And I'm glad to have you here as a speaker, Nicholas.
Thank you for having me.
Yeah. Okay, so Ife?
Yeah.
Are you on the line? Can you hear me?
I can.
Okay, so I'm handing over this session to you for you to introduce us to what, everybody that signed up is expecting to hear, what is this financial reporting that I'm seeing and how can it help my business? Some people are here to find out how it can personally develop them. So I really appreciate the fact that you really took it upon yourself to give us this delightful topic and, just basically let us know it. Thank you very much.
You're welcome. Okay, so I'll share my screen now.
Okay.
Yeah. So good afternoon, everyone, or morning.
Good afternoon.
Yeah, so I'll be speaking about the importance and application of financial reporting for small and medium-sized enterprises. So first off, what is financial reporting? So simply put, financial reporting is the process of divulging an entity's financial information to its stakeholders. So usually people mistake financial reports and financial statements. Financial statements are only a part of a financial report. So among the financial statements, we have five primary financial statements. They include the statement of comprehensive income, statement of financial position, statement of changes in equity, statement of cash flows, and the notes to those prior mentioned four financial statements. On the right, I have the other possible constituents of a financial report. So there could also be a director's report, auditor's reports, general business information, or press releases. Basically, anything that contains financial information that is relevant to users of financial statements is included in a financial report. So on to the importance of financial reporting. So the first importance is that financial reporting allows users of the report to have a holistic financial overview of the business. So basically, the financial statements specifically now provide information about financial performance, financial position, and cash flows of a business. So my colleague Nicholas is going to speak in broader terms about these information. A second importance is the global relevance of reporting standards. So financial reporting is done based on reporting standards. It could be IFRS, which means International Financial Reporting Standards, or it could be in accordance with generally acceptable accounting principles, GAAP for short. And it's important to note that every territory, or relatively all territories in the world, have their own specific GAAP. And having these reporting standards, especially the IFRS, has some importance when it comes to foreign stakeholders, because it's relatively global. So foreign stakeholders have an easy understandability and comprehension of what is contained in the financial reports. Another importance is the fact that financial reports allow for analysis and comparison across entities over time or against industry benchmarks. So it's not just enough to present your financial information. You also have to be able to compare them to see how you have improved or declined over time, or in comparison with other companies. And this is facilitated by financial ratios. So financial ratios, I have a list of the different types of financial ratios here. And each of these financial ratios is, they are calculated using information contained in these financial statements. So that makes them important. And the fact that the financial information is always presented based on accounting standards means that it is consistently presented from one period to another. So it also enhances this comparison and analysis. Then financial reports allows for business expansion and decision making. So in the case of future public listings, publicly listed companies are expected to report their financial statements in accordance with IFRSs. And IFRSs are, well, I'll speak about the applicability of that across the globe in a later slide. With regards to financial needs, when there's a financial reports, banks and other finance providers are able to assess the performance of the company in giving the loans and whatever financing needs that the business requires. For acquisitions, just like in finance, which relates to banks and other finance providers, in acquiring a company or being a target company, the performance of the viability of that business is determined by the financial performance as seen in the financial statements. And then finally, it allows stakeholders in the business to hold managers accountable for how they manage the resources that are at their disposal. So now on to the fun part, the application of financial reporting standards for SMEs. So specifically, I'll be focusing on IFRSs for SMEs. IFRS for SMEs is different from the usual IFRSs. IFRS in broad terms means International Financial Reporting Standards, and they are issued by the International Accounting Standards Board. So the IFRS for SMEs for specifically was issued in 2009, and it was amended in 2015, and it's based on the same principle as the full IFRSs. So IFRSs, typically there are about 45 of them. That is excluding the amendments, and these IFRSs, each of them is at the very least 100 pages long. So they are very cumbersome to use and to apply. So for that reason, the IASB considered the fact that it costs a lot more in terms of time, effort, and money for small and medium-sized enterprises to apply these IFRSs. So in 2019, they issued the IFRS for SMEs, which is based on the principles of all those full IFRSs. But they simplified the recognition and measurement principles. They demand fewer information to be disclosed in the financial statements, and it omits some standards that are not typically relevant to small and medium scale enterprises. So now to define SMEs. So it's funny that the IFRS does not define small and medium scale enterprises based on their size. Rather, it defines these businesses based on the fact that they publish general purpose financial statements. They do not file financial statements with regulatory bodies. So basically, they don't have any listed bonds or stock for the public, and they do not hold assets in fiduciary capacity, regardless of whether they are public or private. So especially the last one, what that implies is that insurance companies, mutual funds, and banks cannot be small and medium scale enterprise. So they cannot apply the standard for small and medium scale enterprises, because even if they are private companies, they are still accountable to the public for the assets that they hold. So they are not allowed to apply this accounting standard. Yes, so I had spoken about the global relevance of financial reporting before. So just to expand on that, IFRS adoption has been adopted by 84% of United Nations recognized territories or countries, and among these 84%, 52% of them have adopted IFRS for small and medium scale enterprises. 5% of them are considering adopting this financial standard, and only 43% of these 84% territories are neither applying nor considering applying the standard. So this just speaks to the fact that it is very relevant, seeing that a very significant proportion of countries around the world apply this accounting standard. So just briefly, like I mentioned earlier, financial reporting could be in accordance to GAAPs, the generally accepted accounting principles, or IFRSs. So to expand on the difference between the two, the IFRS for SMEs, they require simplified disclosures. For inventory valuation, they prohibit LIFO. So LIFO means last in, first out, and that's it's an inventory valuation method that assumes the inventory that come in last in a company are sold first, and that doesn't typically represent the true economic situation of a company. So IFRS has experienced that. There are a few others here, so yeah, just for the sake of time. So in first-time adoption of IFRS for SME, so this is dealt with in section 35 of the IFRS for SMEs. Yeah. Just a side comment. The IFRS for SMEs is a 250-page document, and that is the only thing that is required or applicable to small and medium-scale enterprises as defined before. So, for first-time adoption of IFRS, it doesn't just mean that it is the first time an SME is applying this standard. It means it's a company could be said to be adopting IFRS for SMEs for the first time if it has never presented its financial statements before, if it has presented its most recent financial statements based on another standard other than this particular standard, and if a previous financial statement was was presented in accordance with the full IFRS. So that's just to say that even if a company was using the full IFRS before, but then it decides to leave the full IFRS and adopt only the IFRS for SMEs, it has to treat that financial statement as if it is the first time it is adopting that standard, because it is anyway. So for compulsory disclosure for these first-time adopters of the standard, first off, the effect of the adoption of financial performance, position, and cash flow must be indicated. So usually this is in the last part of the financial statement for the SMEs. So basically, the company has to show what the financial information would have been if the standard had not been adopted. And then it has to also show the adjustments that occurred because of adoption of that standard. And then finally, the results as a result of the adoption of that standard. Secondly, for a company who had adopted IFRS for SMEs before, and then for some reason did not adopt it in its most previous financial statements, it has to state the reason for suspending the adoption of that standard, and the reason for also resuming it in that present reporting period. Then thirdly, description of each change in accounting policy. I'll explain that in the next slide. And reconciliation of equity for policy changes and pre-adoption errors. I'll explain in the next slide. So changes in accounting policies. So accounting policies, according to IFRS, is defined as specific principles, bases, conventions, rules, and practices applied by an entity in preparing and presenting its financial statements. So basically what this means is that accounting policy is the method that is used to determine the numbers that go into a financial statement. So when these accounting policies, when a company leaves one reporting standard for another, it is expected that some accounting policies, some methods that are used in determining financial information will change. So these changes in accounting policy, the result of that change in accounting policy has to be applied, and it is said to be applied retrospectively. So there has to be retrospective accounting for adjustments in the statement of changes in equity at the date of transition. So basically what this means is that, in simple terms, is that, for instance, if I am applying the financial standard as at 31st December 2020, I have to show what the 2019 result would have been if I had applied it in 2019. And then that change has to be shown in my statement of changes in equity. We'll see the statement of changes in equity, like how it looks when Nicholas gives his presentation. So even though the changes in accounting policies have to be disclosed and the results of those changes have to be disclosed, there are some exemptions to that rule. Some of the exemptions include prior to recognition of financial assets and liabilities. So financial assets and liabilities, financial assets are assets, they include cash, or any contract that allows an entity to receive cash or exchange one financial asset for another. So in a case where before adopting the standard, a financial asset had already been taken out of the company's books, when the standard is now adopted, there's no requirement to go back in time and account for that financial asset again, because it's considered as expunged already from the books. Secondly, hedge relationships are no longer exist on adoption. So hedge relationships, basically, they exist when it's expected that the value of an asset or liability is going to reduce or increase. Now, to make up for that loss in value of the assets, a company can decide to hold another asset whose value is expected to increase. So the decrease in value of one asset is being offset or being taken care of or matched by the increase in value of the second asset, which is called a hedging instrument. A third exemption is accounting estimates. So like I said before, accounting policy is the method that you use to determine financial information. Accounting estimates is the accounting information itself. So when an accounting estimate changes, it's not required that you you treat it like an accounting policy. You just treat it in the future. So in the future, that's called prospective accounting. You treat it in the present period and in future periods, but you don't go back in time to report for the changes in the results of changes in accounting estimates. A fourth exemption is discontinued operation. So discontinued operation simply means it occurs when a business has disposed of a part of its operations, or is selling off a part of its operations. Then compulsory disclosure. So regardless of whether it is a first-time adoption or it is a subsequent financial report, there are certain things that must be included in the financial statements. And by financial statements, I mean the 5 of them mentioned earlier. So those compulsory disclosures are, first of all, the name of each financial statement and note to financial statement. So what it basically means is if that financial statement is a statement of comprehensive income, it must be stated in that statement that this is a statement of comprehensive income. So there must be a header for that financial statement. If it's a statement of cash flow, there must be a header that reads statement of cash flows. And then the name of the entity must be included. It must be included whether it is a consolidated or separate financial statement. So usually we hear group, we hear like Orange Group, Lafarge Group. What that basically means is that there's a parent company. So there's a single company that has control over the other company. So when you put their financial statements together, that's when it's called the consolidated financial statements. And then separate financial statements is the financial statement for each of the parents or subsidiaries. So it has to be stated whether it is a consolidated financial statement for all the entities involved or separate financial statement for each of the entities involved. The reporting date and period, of course, also has to be included, because if you're reporting financial statements, financial information, it has to be known when the date of that report and the period covered by that report. Of course, there also has to be presentation currency and level of rounding. Level of rounding simply means to state whether the information provided in the statements are in millions or in billions or in thousands or just plain numbers. The domicile and legal form of the entity. So where the country of incorporation, country of incorporation, the registered office address, and the nature of the operations and principal activities of the business. Then on to reporting frequency. So basically, how many times does an SME have to report its financial statements if it's applying IFRS for SMEs? So it's required that it should be reported at least once a year, so at least annually. And ordinarily, it should be reported at the same time each year or for the same period each year. And there has to be comparative information included in financial statement items, descriptions, and narratives. So what that basically means, what comparative information means, is that financial information for at least the most previous year should be included in the financial statements. So if I'm preparing, for instance, financial statements for 2020, I must present financial information for 2019 also right beside the 2020 results. And that's just, it allows for comparison of the financial performance or financial position over time. Then a very important point also is that sometimes a company could decide to change its reporting period. And if that's the case, then the company must disclose the fact that it has changed its reporting period. It must disclose why it has changed its reporting period and the fact that the comparative information is not completely comparable. So what I mean by comparable information is not completely comparable is, for instance, as you can see at the images at the bottom, assuming my comparative period is for January 1st, 2019 to December 31st, 2019. That's already 1 year comparative period. And the reporting period as that year is December 31st, right? But if in the current period, if in 2020, for whatever reason, I decide that I want to change my reporting date from December 31st to September 30th, right? That means my current reporting period has changed from January 1st, 2020 to September 30th, 2020, and that is 9 months. So like what that says is that my current reporting period is 9 months. I'm reporting information for 9 months. However, my comparative period information is being reported for 1 year. So I have to make it clear in the financial statements that the two periods are not completely comparable. So obviously, when that happens, all things being equal, the 9 months figures will probably differ a lot from the 1 year information, which is comparative period. So that's why you have to state that fact, so the financial information is not misread. So on to the elements of financial statements. So of course, you can't talk about financial statements without talking about the things that should be put in the financial statements. So three of these, among these elements are assets, liabilities, and equity. And one fact to be aware of is that before a financial information can be included in the statement of changes in equity, the statement of financial position, the statement of cash flow, or the statement of comprehensive income, they must meet the definition of these elements, or the elements that is applicable, and they must also meet certain recognition criteria, which I'll talk about soon. So on to assets. Assets are physical and intangible resources. They must be controlled by the reporting entity. And note that they should be controlled, but they must be controlled by the entity, but they must necessarily be owned or legally owned by the entity. So one example is a leased vehicle, right? When a vehicle is leased and is being used like for the whole reporting period, it's not right, even though you're not the owner of the vehicle by law, you control the use of that resource. It is leased to you. You're the person using it for that whole year. So it would not be fair representation if you don't show in your financial statement that it is an asset to you, because you control the use of that asset. You control the economic benefits that are derived from the use of that asset. So they must be reported in your financial statements. Also, those resources that are controlled by you must have future economic benefits that will flow to your entity. So that what that basically means is that there must be some sort of income or expense or cash flow that comes to your business because you're using that resource. So these three conditions must be met for you to even classify an item as an asset. Then for liabilities, it must be a present legal or constructive obligation. Legal obligation implies that it is required, it is statutory, or it's a contractual obligation. Then a constructive obligation means that based on past patterns, if this is an obligation that has been occurring consistently in the past, then it's expected that in this current period it would also occur. And another situation that you could refer to as a constructive obligation is when the reporting entity has explicitly mentioned that it's going to fulfill that obligation, and the other party to the liability has a valid expectation that that responsibility is going to be met. So that's the first condition to be classified as a liability. Also, it must arise as a result of past events. So something must have already happened for that obligation to occur. An event that is still yet to happen cannot be regarded as a reason for liability. And then the settlement of those liabilities must result in an outflow of economic benefits. So an example, just to explain that last point, an example is accounts payable. So accounts payable are amounts that you are owing your suppliers or your creditors. Now, to settle that responsibility or that obligation, you have to pay something or give something in exchange to your suppliers. So that means that it results in a settlement of outflow of future. It results in outflow of future economic benefits in the future. Then the last one for this slide is equity. So equity is residual assets after deduction of liabilities. So basically, assets is the sum of your liabilities and equity, as Nicholas will explain that further in the next presentation. Then for income and expenses, so income and expenses, they are both flips to, they are both direct opposites of each other. So income increase refers to an increase in economic benefits. Like I said before, economic benefits include income, income and cash flows or revenues. So increase in economic benefits, and it results also in inflow of assets, inflows of economic benefits, asset enhancement or liability decreases. And the result of these things is an increase in equity other than contribution by owners. So contribution by owners just means when the partners or the owners of a business bring capital into the business. So anything that results in an increase in equity other than those contributions by owners are referred to as income. And then on the flip side, expenses are decrease in economic benefits as a result of outflows, depletion of assets, increase in liabilities that result in a decrease in equity other than distribution to owners. So distribution to owners typically is dividend payments. And an important point to note are the fact that an income includes revenues and gains. So revenues refer to income that are as a result of the primary activity of a business, while gains are those that result because of activities that are not the primary business activities of the business. So just to explain that further, for instance, if I own a clothing, if I am a company that sells clothes, right? Revenues would include any income that I receive as a result of selling clothes. But for instance, if I have assets like a delivery van and I sell that delivery van, the income from the sale of that delivery van would not be regarded as a revenue, because selling delivery vans is not my usual business. Selling my delivery van is something outside the usual business of the company. And then for expenses, it encompasses expenses. Ironically, it's referred to as expenses also, and losses. So losses refer to non-primary activity of the business, while expenses refer to the primary activities of the business. Then the second the second group of criteria for these classified financial items to be included in financial statements is the recognition criteria. So there are two recognition criteria. First, it must be probable that future inflow or outflow of economic benefits associated with that item will be received or given off in that reporting period. So what probable means here is that it must be 50% likely, more than 50% likely, that there will be future inflow or outflow of cash because of that item in the reporting period. And then a second criteria is the fact that the cost or the value of that item must be reliably measurable. So if one of these criteria is not met, then it should not be presented on the face of the financial statements. Rather, it should be disclosed. So it shouldn't affect the profits or the net assets of the business. It should only be disclosed that this asset exists. An example of this is probably, just to give an example, a pending lawsuit. So if there's a pending lawsuit and there is less than a 50% likelihood that you're going to win that lawsuit and receive damages for that lawsuit, then it should not be included. The asset from that lawsuit should not be included in your financial statement. It should only be disclosed that there is an impending lawsuit. So next is how to measure the assets and liabilities. So assets and liabilities is typically contained in your statement of financial position, and the way you measure it initially and subsequently are different. So for initial measurement of both financial assets and liabilities and non-financial assets and liabilities is at cost, unless the standard specifically requires a different measurement basis like the fair value. So initial at cost basically means the value at which you acquired that financial asset or the liability is going to be settled. For subsequent financial assets and liabilities measurement, that's after the initial measurement, it's at amortized costs less impairment value. For subsequent non-financial asset measurement, it varies for assets. So it could be a cost or a revaluation model. Cost method basically means that from the initial cost, depreciation is taken out at intervals. So the net book value is what's going to be reported in the financial statements. And revaluation method basically means that the value of the asset is redetermined at intervals, and then that redetermined value is what is reported in financial statements. For accounting basis, different financial statements are presented at different bases. So accrual basis is used for all the financial statements except the statement of cash flows. And accrual basis simply means that the financial information is reported not as cash is received, but as it is incurred. So an example is if somebody has paid rent for the next 5 years, I will not report the rent for the first 4 years at the end of the first year in the statement of comprehensive income. And then the cash basis is basically saying that financial information is reported as cash is received and paid out, but that is only applicable to the statement of cash flows. So, like I said before, not everything in the full IFRS is addressed in the IFRS for SMEs. So, for transactions that are not addressed in that standard, managers are allowed to use their judgment to decide on accounting policies that will apply to that transaction. But whatever accounting policy is used must result in relevant and reliable financial information. And also, the full IFRS may also be consulted to determine a suitable accounting policy for transactions not addressed in standard. So the reporting process generally begins from the journal. So the journal is like a summary of all the transactions that have taken place. So it shows what accounts exactly that those transactions are recorded in, and what amount is recorded, and describes the transaction itself. So from the journal, those entries go into the ledger accounts, which then feed into an unadjusted trial balance, and then adjustment entries are made. So adjustment entries, they include things like accruals, depreciation, and then after the adjustments are entered, there's an adjusted trial balance is derived, which then feeds into the financial statements. And an overarching principle for all these elements of the process is double entry principle. So what this simply means is that for every transaction, there at least two items in financial statements must be affected. So if you receive cash, you account for the cash in a cash account, but a different account also has to be affected by that transaction. So that's basically the overarching principle for any financial reporting process element. And it's also important to note that trial balances, both the unadjusted and adjusted trial balance, must have equal balances on the credit and the debit side. So the credit side, items on the credit side are usually the liabilities, the income, and some equity. And then on the debit side, we have assets, we have expenses, and sometimes equity could also have a debit balance. So the sum of all credit balances and debit balances must be equal for the trial balance to balance, basically. Yeah, so yeah, this all seems very cumbersome, but thankfully there are softwares that actually do the work for you. So you don't necessarily have to do everything yourself. So these financial financial reporting softwares, they take in the inputs and they derive all these other things for you. So they derive your journal, they derive everything from the journal to the financial statements. So yeah, that just simplifies the process of financial reporting for businesses in general. Thank you. Hope I didn't bore you.
Thank you very much. I mean, that was very, very enlightening. I'm an accountant. I'm not an accountant, but accounting, and I didn't know so many things. So I didn't know so many things. So thank you very much for that. Thank you very much for that lecture, Ife. I really appreciate. So right now we are moving to questions and answers time. If you have any questions, of course, I do. If you have any questions for Ife, please feel free. You can unmute your video or type it in the chat and we'll see it. I told you guys she was very brilliant, or she's very brilliant. So she's ready for any of your questions. Everything you said, yeah, it made perfect sense. It was really captivating. But as a business owner, let's say myself as a business owner now, do you think like let's say my business is generating probably 500,000 naira or $10,000. No, $10,000 in a year or $500,000 in a month. Sorry, naira, not dollars. My business was generating $500,000 for no day. So do you think I really need to get why is it important? Why is it important for me to keep accounts? Can't I just go and get paper and biro and just be recording the sales and expenses? Why do I really need to why? I guess I need to know, is it very, very important? My business is not producing enough money. You get? So I should still be recording the small sales. Go away, carry Excel or something. I don't even get what I'm trying to say.
I understand what you're saying. Yeah.
Okay, so thank you.
Yeah. So the thing is, in financial reporting, what you just explained, recording your revenue,
Yeah.
that is only going to show you the profit that you're making, right?
Okay.
But the fact that you're making profit, first of all, doesn't tell you whether you have more liabilities than assets. It doesn't tell you whether your loans are exceeding your assets. It doesn't tell you whether you have enough cash in your business. Ironically, it's actually possible that you have profits, but you have no cash. It's possible.
Yeah.
Yes, because what you see is that, for example, when you take your sales, not every sale will be on a cash basis. You will definitely have some people that will owe you money to pay later.
Yeah.
So with keeping a complete set of accounts, which includes assets, liabilities, income, expenses, revenue, equity, in doing that, you are keeping track of everything in the business. You have a clear picture of every single aspect of your business.
Okay. So, I have another question here. Ogo Isenwa asks, does FIRS standards apply to SMEs in Nigeria, or is it merely a guide?
So first of all, like I said before, SMEs are not publicly listed companies, so it is not a requirement. Like they don't issue public financial instruments. It is not a requirement, but it is applicable. It is recommended, but it is not required. So, so in Nigeria, a private company could decide to use GAAP. It is a private company after all.
Some of us don't have, MSc in finance. We are still learning. You said public company, eh? What is public company? My business is just taking off in one small village. So I want to be a public company one day. What is a public company so that I can be applying this FIRS?
So public companies are those that issue shares or bonds to the public. The public, me, you, anybody can buy the shares. yeah, and they filed their financial reports with SEC, which is Security Exchange Commission.
Okay.
So, yeah, so SEC requires that. So for countries that have adopted IFRS, SEC require, most of them actually, I don't think the US is included, SEC requires that they apply IFRS for public companies. But since SMEs are defined as private companies,
Yeah.
or companies that don't have public fiduciary duty, then they don't have to apply it.
Okay. So I have another question. Okay, so I'm starting up a business, yes?
Yeah.
I'm starting up a business.
Mm-hmm.
I don't have a business, background as my first degree. You get, but I really want to start up this business. And now seeing all you've said about financial reporting, I mean, if I should now decide to just face financial reporting now, I won't sell any market. I don't know if you get my point.
Mm-hmm.
So do you think it's wise for a startup or a business owner to engage the services of an accountant? Do you think it's wise? Okay, because since I've seen the importance now of having this account or having my books, I've seen the importance now. Like, okay, now I'm like, okay, I can't go and start school again from beginning now. I have to sell my products. You get? So do you think it's really necessary? Do you think it's important for me to engage the services of a professional accountant, or if I have a friend who can do it, even if it's probably going to cost a lot? Is it? Do you know if there's any way probably I can do it cheap? You get? So thank you.
Well, first off, there's nothing there's nothing more valuable than in a business. There's nothing more valuable than making informed decisions.
Yeah.
So even though it may seem like it costs a lot, if you're thinking long term, you want your business to be able to be able to exist for a long time, right?
Yeah.
So it's a cost benefit analysis you're going to have to do. You're going to have to look at the costs, look at the benefits, and take your own informed decision. Because I mean, nobody can force you to report. All we can do is say it is important to report. And then again, there's also a place for personal development. You may not have graduated a business major, but with time you can acquire that knowledge. And like I said before, there are softwares that can help you do this. Microsoft Excel has templates for this, right? So it's as easy as downloading Microsoft, paying your license, and downloading a template. And then of course, like it's not a must, but it's necessary.
It's important. Yeah, I understand. Thank you very much.
There's always a way out. For instance, I didn't have a business background.
Okay.
I was a pure science student. Accounting was just something that I decided, I'm going to do this. So with time, things will,
Yeah, thank you very much. Do we have any other question from this?
Oh, yes, I do.
Okay, please feel free.
Okay, thank you very much. It was a very, very beautiful presentation. I personally have learned a lot from this. But I want to know the distinction between assets, liability, and equity, particularly equity. I'm not so clear on what equity means, like area all the time, but I'm not so clear on it. I know what assets and I know what liability is, but if you can just give me a definition or an example of what equity is, and then just help me with a clear distinction between the three of them. Thank you.
Okay, so just to understand your question, you want me to explain what equity means, right?
Yes, I do. Yes.
So usually, like I said, the statement of financial position is one of the financial statements in the financial report, right? Now, in that statement of financial position, you have three classes of items. You have assets, you have liabilities, and you have equity. Now, from Nicholas's presentation, you're going to see that when they split the financial statements, right? The sum of the assets and the sum of the liabilities and the equity must always be equal to the sum of the assets. So equity is basically those assets that are not liabilities. In simple terms, that's what it is. And an example of that is share capital. So you issue shares and you receive money or property or plants or something from your investors. That is classified. That is a class of equity. Another class of equity is retained earnings. So retained earnings is your accumulated profits over the life of the business. So if I make, assuming I make 5,000 naira profits in 2018, and then I make 5,000 naira profit again in 2019, that means at the end of 2019, my retained earnings will be 5,000 plus 5,000, that's 10,000. So you just keep accumulating your profits over time. So those are two very typical examples of equity in a financial statement.
All right, thank you very much.
Okay. Do we have any other question before we wrap it up? I really do appreciate you, Ife, for this. Thank you so much. Thank you. Sorry, Ogo, I believe.
Yes.
Let me just, like.
I have a question, please.
Okay, please feel very free, please. Edwin. Hello? Hello, Edwin.
Yeah.
We are waiting for your question, please.
Yeah, I'm talking.
Okay.
Can you hear me now, please?
I can hear you. I can hear you now.
Okay, so I run a corporate account for my business. So since 2018, that I registered that business, so monies have been coming in and out for a different purpose, like, okay, specifically for traveling purposes. People have been paying me money that are just going in and out for like maybe between 10 to 5 million, 5 to 10 million.
Mm-hmm.
So it's almost 2 years now. And I know me filing reports. I don't know, does it count with the FRS?
Are you a publicly listed company?
Yes, I am.
And you will not be filing. It's not catch you.
So now we want to use the account for valid purposes now, but we are scared that, okay, they'll come and confront us to start filing the 2 years funds that have been going in and out.
Mm-hmm.
And I read somewhere that if you're a startup, you're free from filing this return for the first 2 years. How true is that?
Okay. First off, this sounds like a legal issue. I am not a legal professional. I'm an accountant. So you should probably consult with. I'd suggest you consult with a legal professional because I can't speak to that. It's not my area of specialization. Sorry, I couldn't answer your question.
Oh, is there no law that covers that? Like,
there's probably a law that covers that, but like I said, I am not a legal professional. I studied accounting, not law. So, and then again, I did not study in Nigeria. So, and the laws change from one jurisdiction to another. So I can't speak to that. I'm sorry.
Okay, thank you.
Sorry, what's the basic law? Like, what's the normal from accounting point of view now? Your first 2 years of
So that's another thing. I am not a lawyer. I can't speak to the law. It is not my specialization. So I would rather not give information that is conflicting. I'm sorry.
All right, thank you very much.
All right.
Okay. Do we have another question?
Sorry,
last question.
Hello, Edwin. Yeah, I wanted to say that we can have a conversation about that personally. Maybe after the webinar, I can give you some advice in regards to that.
Okay, I really appreciate it.
You're welcome.
Thank you.
Yeah.
Okay. So, do we have any other question? Our last question in the house. If not, we move forward and we appreciate you, Ife.
Yeah,
we wish
I have
you were a
some
lawyer.
questions.
We wish you were a lawyer, but you're not a lawyer. You can study law. It's not hard. Ask Jude.
No thanks. I'm very satisfied.
Okay.
Sorry, I have something to say.
Okay.
I'm wondering if Jude can make this advice general so that we can benefit from it too.
Okay.
Oh, it seems we have people in similar situation. Like
Okay.
me.
To be very honest, I have to do research to get back to you. I've lost on that. But I believe that normally what they do is that they give a tax holiday. I'm very sure of tax holiday for startups. Like if you register at the CAC, you're giving like a 1 year or 2 year, an 18 months break not to file your taxes so that you can get yourself in order. But I'm not aware of financial reporting. I'm not very sure of that. So of course, like Lota said, you have to, do your proper research so that you're stating your facts on authority, not just,
Yes.
So that's it. So I'll get back to you and Chisom on it personally. I'll do my research and then I'll let you know. Thank you.
Okay, thank you, everyone. We're moving to the next speaker, Nicholas. Nicholas is another brilliant accountant we have. He's a consultant in the making, very successful. And so in case you have a small business and you need to hire a consultant, Nicholas is your guy. Thank you very much. Nicholas, over to you. If you don't mind sharing your computer, please.
Yep, of course.
Yeah, thank you very much, Nicholas.
All right. All right. So I just wanted to first off say good morning and good afternoon, depending on where you're viewing from. I want to thank everyone for taking time out of their day today to attend this webinar held by EAYF. Hopefully you guys are learning some good information. I want to thank you guys for inviting me to talk about this webinar on a very important topic of financial reporting and financial statements. Thank you, Lotta, for the great presentation. I think you did a great job at setting up for what I'm going to be talking about next, which is how to utilize financial statements. A little background about myself and why I'm here to talk about this today. I'm currently a master's student at Holt, studying international business and business analytics. Prior to that, I graduated with a finance degree at the University of Texas, San Antonio. And then I immediately started working for a medium-sized enterprise known as Rackspace, which is a tech firm. And that's where I really honed in on my accounting skills in their treasury department. Believe it or not, I actually hate accounting ever since undergrad. It was not my favorite subject at all. But with that being said, it is a very crucial part to know to be able to, have an understanding of financial reporting and financial statements. So without further ado, let's go ahead and get into some of the topics I'm going to be talking about today. So these are the typical 5 types of financial statements that we see firms using. You see the balance sheet, income statement, which is also known as a profit and loss statement, statement of cash flows, statement of change in equity, and the notes to the financial statements. Now, for the sake of time, I'm only going to be covering these top 3 here that I am highlighting. I'm not saying that not all of these are important. They're all important in their own respective, but since this is a webinar geared more towards startups and SMEs, I believe the balance sheet, income statement, and cash flows is a lot more important to at least have the basics and know the understanding of these to be able to really run your business well. So let's go ahead and get started with the first financial statements. So the first financial statement we have is the income statement. Now, most people will argue that this is probably one of the most important financial statements to pay attention to. What it is, it's a summary of your revenue and expenses of a company over a reporting period. Essentially, it tells you whether or not you're a profitable company. It lets you know, okay, after everything considered, am I turning a profit? What is left over from this? So we'll go ahead and run through this income statement here on the right, and I'll go through each line item and kind of explain to you guys what these each mean. And that way you guys can get an understanding of how this income statement is built. So first off, we have revenue. And revenue, in simply put terms, is an income of a company. What are you bringing in, depending on what your product or your service is. So you'll always start with your revenue. And then from there, you will subtract out any of your cost of goods sold. Now, cost of goods sold is exactly what it sounds like. It is how much was it for you to produce this product or for you to curate this service? You know, it's basically the cost of doing business of production. So once you take your revenue and you subtract out your cost of goods sold, you're left with your gross profit here. Your gross profit can also be known as your margin. It's essentially what is left over and what you're able to gain after selling your product. But that's not where it stops, because after gross profits, you have to begin considering other expenses that you might have. So the first expense that we have is operating expenses. These are different from the cost of goods sold because operating expenses is the cost of doing business. Here you can see it says SG&A, which is selling, general, and administrative expenses. So this can range from anything from rent, utilities, buying items for your office, and it's basically your overhead cost. So when you take your gross profit and you subtract out your operating expenses, you're then left with an operating income. Now, your operating income can usually be known either as an EBIT or an EBITDA. Now, what EBIT stands for is your earnings before interest and taxes. Very similar to that there is EBITDA, which is earnings before interest, taxes, but also depreciation and amortization. Whether you have EBIT or EBITDA really depends on your firm and what kind of services or products you're selling. Typically, you'll have EBITDA if you have any sort of depreciable asset. Say you have a machine that on day one, once you buy it, it begins to decline in value. And that's where you'll begin to account for depreciation and amortization. But in the case of this financial statement, they only use EBIT. So we'll go ahead and go with EBIT for this. So now you have operating income, or your EBIT, and then you begin to take out your interest and taxes. So the first thing that you're going to take out from your operating income is your interest expense. Now, interest expense arises anytime that you take on debt. So you take on debt when you go pull out a loan from either a bank or some sort of financial institution. And over time, obviously, banks take interest as a payment for that loan. So when you're accruing these expenses, you also want to pay them back, because obviously, if not, you might default on the loan and your business might go under. So you take out the interest expense from your operating income because that's how much you owe to the bank, and that's the cost of doing business. And once you take out your interest expense from your EBIT, you're then left with your pre-tax income. From your pre-tax income, obviously, you're going to start taking out any kind of taxes you have. For this firm, they have income tax expense, but this is not, exhaustive of any tax that you might have. It might be state, it might be federal. Really depends on where you are and what are the rules and regulations that you have. So finally, once you take out the tax from your pre-tax income, you now have your net income. Now, this is the magic number right here. Your net income is your profit, essentially. This lets people know, or investors know, this is how much I am able to produce. This is my final number that I am able to produce after everything. Now, with your net income, typically firms will do three things with their net income. You can either, one, reinvest back into the company, because obviously you want your business to grow, right? You don't want to stay the same size forever. So oftentimes people will reinvest back into the company in whatever way that they can, or they begin to pay down on the debt. Because you take on leverage, obviously leverage comes with interest. So the more debt you pay down, the less interest you'll start to accrue and the less interest you have to pay. So it will help, kind of alleviate some of the leverage that you take on. The third thing that people typically do with net income, and this is not really typical for small businesses, but they'll pay out any dividends to shareholders and any sort of investors. Now, a dividend is basically just a payment to anyone that's invested in your business. This is more common for publicly traded companies, and it's not a requirement, but if you want to gain the trust or the support of your shareholders, sometimes people will pay out a portion of their earnings to say, thank you for investing to our company and believing in us. Here's a small dividend to show that we are grateful for that. So now that we have net income, we can take that amount and move it into our next financial statement, which is the statement of cash flows. Now, the statement of cash flows is exactly what it sounds like. It is a statement that shows the inflows and outflows of cash and cash equivalents over a certain reporting period. Now, with a certain statement of cash flows, you always start with your net income, which is derived from your income statement. So the first line item you see here on the statement of cash flow is your net income. And the statement of cash flow is consisted of 3 sections. It is consisted of cash flows from operating activities, from investing activities, and from financing activities. So let's start with operating activities first. First, you start with your net income, as we mentioned before, and then we begin to add back non-cash items from operating activities. So that means depreciation and amortization. Now, the reason that you add back non-cash items to your net income is for tax purposes. While non-cash items don't affect your bottom line like it does in the income statement, you do this so that way when you're reporting on cash flows, people still know that, oh, they had cash flows that went towards their depreciation, and then you can potentially get tax breaks and, you know, have some leeway and potentially get any sort of money back from that. You know, you're able to save a little bit on taxes. So you add back any non-cash items, you add or subtract any changes in working capital. And working capital is typically anything that is used on a day-to-day basis for your firm. So whether that's cash, inventory, receivables, payables, anything along those sorts. So we can see here that this firm has some changes in accounts receivables, inventory, and accounts payable. So they went ahead and subtracted out the changes from receivables and inventory and added back accounts payable. After we do all of this, we're now left with the net cash provided from operating activities. Now that we have net cash provided by operating activities, let's go ahead and move on to the cash flows from investing activities. Now, cash flows from investing activities can range from a lot of things. It's exactly what it sounds like. It's cash flows that you put into investing. For example, a typical thing that you would do is purchase property, plant, or equipment, correct? So anything, whether it's adding or subtracting, where it's buying or selling land, you'll also consider that cash flow into the statement of cash flows. So this firm has capital expenditure from the purchase of property, plant, and equipment. That's what PP&E stands for. So you can see that there's an outflow cash here of 70. So that's the only cash flow that they have that's outgoing. So that's it. And that will result in a net cash flow of investing activities of minus 70. The very last section that we have from the statement of cash flow is cash flows from financing activities. Financing activities can happen in 2 ways, either through equity or debt. Typically, as a small startup or SME, you will typically lean more towards debt because equity is typically more for publicly traded firms. When you do debt, you usually go get a loan from the bank, or if for some reason, you know, you're trading bonds somehow as a startup, that would be pretty amazing. But usually any money that you receive or that you lose from this, you will also consider here. So you take a look here, there's no revolving credit facility, so we don't need to worry about that. Long-term debt, it looks like they are losing 50 million, so they are probably paying back their debt. So that means that they are paying down on this debt, so they're actually reducing the amount of leverage that is in the company. So once we gather the cash flows from operating activities, investing, finance, and everything, we are left with a net cash flow here at the bottom. Now, it's important to note that this net cash flow is not your profitability. That's your net income. Your net cash flow simply tells you this is how much money was going in and out, and this is the ultimate amount that we're left with to show either a positive increase in cash or a negative increase in cash. And essentially, the net cash flow then flows into our next financial statement, which is the balance sheet. Now, the balance sheet kind of ties everything together at the end. A balance sheet, the best way to think of this is it is a snapshot of a company's assets and liabilities and equity at a specific point in time. So the biggest thing here is that as Lotta mentioned, that there is an equation called assets equals liabilities plus shareholders' equity. The biggest thing here is that it can really depend on what you're doing. So one thing to mention, the balance sheet here is that it's shown top to bottom, right? You have your assets on the top and your liabilities and equity on the bottom. Sometimes it can come in different forms. I've also seen it in forms where you have assets on the left-hand side and liabilities and stockholders' equity on the right-hand side. Boiled down, the easiest way to explain assets and liabilities is assets is what we own and liabilities is what we owe. So when we take a look at the equation, assets equals liabilities and shareholders' equity, you want them to balance out because after all, this is a balance sheet. Typical assets that you'll see is anything from cash, receivables, inventory, and fixed assets, whether they're tangible or intangible. Liabilities, payables, accrued liabilities, debt, and then you can also have shareholders' equity in outstanding shares, additional paid-in capital, retained earnings, and treasury stock. Now, one thing to mention is I did say that I would not be covering the change in equity statement today, but you're always going to have an equity portion on your financial reporting. And the reason being is because you're always going to have retained earnings, which as Lotta mentioned is an accumulation of your net income period over period. Now, while you may be a small startup and you may not have, the equity or the common stock to release to the public, you're always going to have retained earnings because that shows to investors or people from the outside looking in that, oh, this company has a net income that they carry over from period to period. So retained earnings is always going to be under your equity here, regardless of whether or not you're a publicly traded company. So let's go ahead and go through this balance sheet a little bit. So you first start with your current assets, which is here for this firm, cash, accounts receivable, and inventory. It varies from company to company depending on what they have as current assets. Just for the sake of continuity, we'll go ahead and just follow these that they have. So once you add up all of your current assets, you get a total current asset. And then you also have to account for any long-term assets. This then falls into the category of PP&Es typically, so property, plant, and equipment. Anything that has a long time life value that you're going to be using for a while, whether they're tangible or intangible. So once you have your total current assets in your long-term assets, you're able to add those two up and get the total assets. And here in the year 20X1, we have 1,559 for total assets. So that's it for the left side of our balance sheet, the asset side. Now let's go ahead and move to the right side, or the liabilities and shareholder equity side. Similar to the asset side, we'll first start off with our total current liabilities. This is anything that is within the period. So here they have accounts payable and the current portion on long-term debt. Once you add those two together, you get your total current liabilities. And then you move on to your long-term liabilities, long-term debt. One thing I do want to mention here is you do see here, it says long-term debt and current portion of long-term debt. And the reason that occurs is because, as Lotta mentioned, is there's something called an accrual basis of accounting. So typically when you pull out a loan, right, you're gonna eventually pay it out over a certain amount of time, whether it's 3 years, 5 years, 10 years. But when you're accounting for it, you're not going to account for the whole portion of debt on your total current liabilities, because it wouldn't make sense to show all of your total debt on current liabilities. So the reason that they break it out to current portion of long-term debt is because this is how much is owed from that long-term debt in this period. So you can see here that they have 50, 50, 50 every year. That's the only portion that they need to pay of the overall long-term debt. So that's the whole reason why they have it split out into a current portion and a long-term debt portion. And then that all goes back to the reason of being on an accrual basis, essentially. So continuing on, now that we have total current liabilities and long-term liabilities, once we add those together, we get total liabilities, and then we can move into our shareholder equities. As mentioned before, typically startups won't have common stock, but on this firm, they do have common stock. So this is most likely a publicly traded company, and they'll account for any common stock that you have here and your retained earnings. Now, your retained earnings is, as said before, an accumulation of your net income. So let's break this down real quick for retained earnings. Say in the year 20X0, you had 843 in retained earnings. And now you calculate everything in your income statement. You say, hey, I have 100 now from my net income. So what you would do is you would take that 100 and you would add it to the 843 in the the prior year essentially, and you get your retained earnings for that current period. So it's essentially, like it says, an accumulation of your net income. So as you can see here in retained earnings, they continue on 943, 1,000, 139.7. And the difference between those two is essentially how much net income they had period over period. And so that's essentially how the retained earnings area works. So after you add up your stocks and retained earnings, you get your total equity. And now the last thing to do is to just sum up your total liabilities and your total equity. And look at that, what do you know? You get 1,559. And that is of course correct, because we know from our equation, assets must equal liabilities and shareholder equity. And we have here assets is 1,559. And we have here that total liabilities and equity is 1,559. So in accounting, the magic number is always 0. You know, this is a balance sheet, so you're going to want things to typically balance out to 0. And Lota did mention that there are journal entries, right? So the balance sheet is kind of a big picture of how it's going, but what really makes up the balance sheet are journal entries. And I'm gonna go into a little bit of detail about debits and credits and how a balance sheet is kind of actually built. So in accounting, there is such a thing as debits and credits, which essentially shows how a transaction affects a certain type of category. For example, here, we'll start with assets, right? Debits are always on the left side and credits are always on the right side, no matter what. The only thing that changes is what a debit and credit does to the category. It is a little bit confusing to explain this, so please do bear with me. I'll do an example so that way we can get a better idea. So for assets, debits is always going to increase the category, whereas a credit is always going to decrease the category. Whereas on the opposite end, if you look at liabilities, a debit will always decrease the category, but the credit will always increase the category. And you can kind of go through each category and see, you know, what a debit and credit does. And this way you can always know, you know, oh, this is what a debit does on an expense. This is what a credit does on an expense and whatnot. The typical most 5 important categories that we focus on is the assets, liabilities, and shareholders' equity from the balance sheet, and the expenses and the revenues from the income statement. So I know that is a lot to kind of explain. So let's go ahead and do an example so I can kind of show you how this works for a journal entry. We usually do a journal entry with what's called a T chart, which is exactly what you see here because it looks like a T. And the example I'll be doing today is raising cash through a loan from the bank. So I'm a business owner. I run company XYZ, and I say, you know what? I need a small loan to be able to get the marketing material I need done for my company. So I go to bank XYZ. I say, hi, I'd like a loan for $1,000. They look through everything. They're like, great, everything looks good. Here's your loan for $1,000. And going home, and the first thing I do, being an accountant and having a financial background, I make a transaction because I would like to know later on at the end of the year what I was doing with this cash and like how it worked out. So the first thing to do when you're making a transaction, to think about the transaction of what just happened. You're raising cash through a loan from the bank, correct? So you know that you are gaining an asset. You are gaining cash. So obviously your cash is going to go up. So meaning your asset is going to go up. Now, whenever you make a journal entry, so say you make a debit entry over here, there always has to be an opposing credit entry and vice versa. So once you make a debit entry, always has to be a credit entry. Once you make a credit entry, always has to be a debit entry, really depending on what categories you're looking at. So when we're talking about getting cash from a loan, we're talking about an asset and a little liability, right? Because asset is what we own, liability is what we owe. Now we own cash from the bank, but we owe money to the bank as well. So the way that we would account for this in a journal entry is you would account for 1,000, you would debit your cash account or an asset account to increase by 1,000 because you received $1,000 in cash. Simultaneously, however, there needs to be an opposing entry on your liability side because now you owe somebody something. And so contrary to that, you will put a credit on your liability side. So your liability will also increase now, which lets you know, hey, I owe somebody a short-term debt. I owe somebody, the bank, $1,000. So now this is your first entry of the of the loan. So you received $1,000, great, a debit, and then you also credit your liability because you owe somebody $1,000. Now, what happens when a few months go by, your business is doing really well, you make the money that you need to, and now you're able to pay back that loan. So now that you're able to pay back that loan, you give $1,000 back to the bank, correct? Meaning now that your cash is going to decrease, your asset is going to decrease because you're losing $1,000 because you're paying it back. So the first thing is you do is you're going to credit your asset to offset the first entry that happened. So now, opposite of this, you credit the asset, but you're going to debit your liabilities, which will also decrease it. So now that you can see here, your credit and debit is opposing each other, right? So you're losing $1,000, but you're also reducing the amount that you owe to the bank, $1,000. And essentially what you get after everything is a net of 0, right? So you can see here, 1,000, 1,000, this would cancel out to 0. 1,000, 1,000 over here, this would also cancel out to 0. And essentially that's how a journal entry works. It is really a lot to take in, especially if you don't have an accounting or financial background. But the best thing I can tell you to do is to practice, practice, and practice. You know, I didn't gain my accounting knowledge overnight. I took probably a good 2 to 3 years before I actually gained a grasp of how to actually do journal entries and how to take a look at financial statements. So if you're really confused right now, don't worry. I was in the same exact shoes. Just be confident and continue practicing your skills. And that's how you'll really be able to get a hold of journal entries, balance sheets, and everything else that goes along with this. Okay, now I know I've thrown a lot of information at you within the past 20, 25 minutes, but let's just take a breather here for a moment and take one step back and take a look at the big picture, right? So going back to the beginning, I started with an income statement. And from the income statement, I derived a net income. So the income statement produces a net income. Now that net income flows into the statement of cash flows as your first line item, as we know, to account for your cash flows. In addition, that net income also flows into your retained earnings on your balance sheet. From your cash flow statement, you get your net cash flow, which you will add to your prior year's cash balance to get your current year cash balance. So if you take a look at 20x3 here, cash and balance sheet, you have 809. You have 809 beginning cash balance of that year. To get the cash balance of the current year of 20x4, you're gonna take your net cash flow from your cash flow statement and you're gonna add that to the prior year to get this 1,026. So you can kind of see here how the arrows are kind of pointing where things go, and it kind of shows you the linkages between everything. This kind of gives you a better idea of how all these financial statements are interconnected, and that way you can have a better understanding of, okay, I need this before I can move on to the next step and whatnot. So typically the order I would like to follow is produce an income statement first, then go ahead and produce a cash flow statement, and then finally finish off with the balance sheet. A way I like to look at it is a balance sheet is an in-depth look of your income statement, right? Think about it like this. Your income statement is a report card for your school. It shows your grades for the whole year. You know, it shows A, B, A. But what makes up those grades, right? What makes up the grades that you see on your report card? Well, the thing that makes it up is your test grades, your quiz grades, you know, homework grade. And that's what a balance sheet is. It's an in-depth look at how does your income statement really play out, and like how does it look from, you know, where is my money coming in? Where am I losing money? And to take that a first step down, your balance sheet is further improved on by a cash flow statement. And your cash flow statement is what, you know, really breaks down your balance sheet and allows you to have a bigger picture overall. So the last thing I really want to leave you guys off with is, you know, keep a record of all your financials, whether it's physically or digitally. I know it is very cumbersome, as Lotta had explained, to, you know, keep a record of your financials, but you will be in much better shape at the end of the year or your reporting period if you're able to backtrack and have a paper trail of everything that you've done financially. Another tip that I'd like to say is invest in a software such as QuickBooks, because then you'll be able to more easily visualize your finances as well as having it organized. I know QuickBooks does have some functionality of reports. I personally never used it, but I know that as long as you enter in and stay consistent with what you're entering in, you can pull up a report of an income statement at the end of the year, and you can just print it out and have, you know, a record of it. And really, that's my speech. The rest of my PowerPoints are just some helpful links to understand accounting more. I had to research a lot again before, you know, presenting to you guys. So I included some of the links here that I took a look at to kind of go through this. And if you guys have any questions over that, feel free to take a look at the links. And here are some more links. Over here is a cheat sheet of some of the key important items and definition of the different financial statements that we've covered today. And at this point, I'd be happy to take any questions that you guys have. And yeah, I hope I was able to teach you guys something.
Okay, thank you, Nicholas, for that, you know, very long math class that has really put me in perspective about
Yeah.
assets and liabilities. Thank you very much. So please, it's time for questions and answers to Nicholas. Feel very free to ask your questions. Feel very free. Nicholas is willing to answer. As you can see from his presentation, nobody needs to tell you that he's a brilliant consultant in case you still need to hire an accountant. From his presentation, you can see.
I'm working towards it,
yeah, I mean, you're going to get there very soon, Nicholas. You're going to get there very soon.
Thank you.
So please, if you have any questions, feel very free to ask Nicholas. Feel very free.
Hello, Nicholas. Hi. Okay.
No, you go on.
Okay. Nice presentation. Lotatu also, nice presentation. I just have one question. You know, back in school, you're always my Lota. So I wanted to ask you, in regards to your net income, that is your net income, the total revenue, when it goes into the cash flow, like, can you explain that process? Why do you take it to the cash flow instead of the balance, instead of the income statement, if I'm not mistaken? I just wanted to understand that net income aspect. Why does it start the cash flow?
Right, yeah. So just to clarify your question, you want to understand why net income flows into the statement of cash flows next, correct?
Yes,
and
yes.
Why you start with that, right? So the whole reason that you start with that is because your net income is kind of your baseline, right? Your net income is your golden standard. Like, this is how much I make. The reason why you start with that is in your statement of cash flows is with your statement of cash flows, you kind of start working backwards, right? You kind of look at the inflows and outflows to kind of account for, like, okay, I know that I made this much in accounts receivable or whatnot, and you add it on to the net income. So that's where the changes in working capital comes to play. You take that net income and you begin, you know, accounting for everything that's cash or cash equivalent to be able to come to your net cash flow. And that really gives you an overall view of what is the cash flow, you know, like what is the increase in net cash flow or what is the decrease. So that all starts from the net income, and that's the whole reason why you start with that. Because I think the income statement is always usually the first financial statement that's made. And so because you start with the income statement, then that's the only way you'll start to begin to either build a balance sheet or a statement of cash flows. So income statement always comes first because you need your net income for everything else. But then after that, it's kind of up to you whether you want to do a balance sheet or a cash flow statement. I hope that answered your question.
Hello, Jude. Are you satisfied with the answer to the question?
Yeah, I'm very satisfied. Thank you.
Okay, thank you, Jonathan. Thank you, Nicholas, once again. Thank you very much. Do we have any other question? Feel very free to ask. Feel very free. And you can also look up Nicholas and Ife on LinkedIn to connect with them in case you still want to clarify some accounting concepts or financial reporting concepts with them. You can look them up on LinkedIn.
Yeah, hi Nicholas. Hi everyone. Sorry I came a bit late. Thank you. It's been a very educative and informative session. You know, I'm not a finance person. I'm a lawyer, so many of these things are quite
Yeah.
foreign to me. But then,
Right.
regardless, you know, this may seem like a broad question, but then its answer is still relevant regardless. So, what do you think are commonplace issues, you know, that you think it's more or less a given that anyone who is engaging in financial reporting or financial record keeping would face, you know, and then what do you think is the easy and the fastest way to overcome these?
Right. The most. So speaking personally, I think the biggest issues I ran into when I was, learning accounting and the ropes of accounting is really having an understanding for the categories and the transactions. It all starts with journal entries. The whole thing I showed you with the T charts and things like that, it really all starts with that as a basis. So understanding when an asset should go up or when it should go down or what is the opposite side of that. I think that's the biggest thing that you need to learn and have a good grasp on before you can effectively build a well built out financial statement. So typically I do see a lot of issues with that. I mean, even my colleagues, when we were working through issues through our accounting software, we always had an issue tracing back, okay, where did this money go? Like, what account is it in? And why is this going up? And why is this going down? So having a good understanding of the assets and the liabilities and, the equity that you're looking into and knowing what each line item is and what it actually does, I think that will set you up for a much better position to understand financial statements overall in the end.
Oh, thank you very much. Thank you.
Sorry, and just to add on that, onto that, right? I also, from my experience, realized that there's an issue regarding how to measure those financial items. But the good thing is that the standards are readily available. Like I don't know how to measure everything. I've been doing financial reporting for 2 years, and yet when I meet some financial items, I still have to go back to the standards. So the thing is, regardless of what issue you have in your financial reporting, you can always refer to those standards. There's a website for it, EIFRS.org. It basically has all the standards there. All you have to do is sign in and you can download the standards and go through them whenever you have an issue. So that's a helpful tip for SMEs.
Yeah, and actually, Lala brings up a really, really good point. I have a really good example of that. So when I worked at Rackspace, I took care of the North American accounts typically, and we had our own GAAP reporting. However, we also worked with a treasury team in the UK, and whenever we got the UK's financial statements and we looked at it, our numbers were completely different, sometimes by like hundreds, and we couldn't understand why. What was the difference? And I think having that standardization, really helped us derive, okay, this is why the UK is accounting for this, but we're not. And it really helped us build our consolidated balance sheets and income statements. So regardless, of what country you're from, there's always a standard, and you can always easily look into it and understand why is there a difference in the numbers that we're seeing from country to country to be able to really build a better, bigger picture of all the financial statements that you see overall. So you bring up a really good point when saying that, Lota. Thanks.
Sorry, Nick, someone is asking if you could kindly share those links from your slide. Yep. And Lota, if you have any links that you want to also share as well, to be very helpful so that they can do their own personal research. Because of course, this is just the basics of our presentation. Like, you still have to go further. I myself, I know that accounting is really a very, foreign subject to me and all. So I'm always trying to learn new, accounting terms and learning how to use it well. And another thing I would recommend is Cengage. Yes, Cengage is a very good accounting tool for learning accounting. but you pay for it. It is a subscribed package, but you gain a lot. It explains everything, and then it shows you practical examples, also gives you tests and exams and all of that. So yes, thank you.
Okay, thank you very much, Nicholas, Jude, and Ife. I mean, we are almost at the end of this session. I mean, it's been a journey. It's been a journey. I mean, like, accounting on his own, man. Accounting on his own is not an easy something. I can remember when I got into 100 level then, I had to read essential accounting all over again. I'm like, God, debit and credit, it's not easy. But regardless, yeah, I feel, regardless of if you're a lawyer, whatever professional line you may belong to, and you want to venture into business, you can't run away from accounting. I mean, accounting is the language of business. I mean, just as you have English as our official language, accounting is the language of money. And if you're involved in anything that involves money, you need to know accounting. I mean, you need to make that extra effort to actually go and educate yourself on accounting. And just to sum up everything, the speakers have presented to us today and said to us, starting from Ife made us realize the need and the importance for us to actually familiarize ourselves with keeping proper records. While Nicholas went down to the grain of it to actually show how to keep these records, which is something I'm very appreciative about. Like, from the whole thing, I got to understand that, okay, yeah, we have the different statements, starting from the income statement. Yeah, the income statement is the statement that just basically tells you, yeah, my business is making profits. That's what the income statement is. Then the statement of financial position, yeah, it basically shows you that, yeah, like, this is what I own in my business. This is what I do not own. You get. Robert Kiyosaki said that assets is anything that put money into your pocket. Liabilities take out money from your pocket. That's just the summary of the statement of financial position. Then you move to the cash flow. Cash flow basically shows you the cash that was used within that current period. Please correct me if I'm wrong, please. Like I said, I'm still a learner. Correct me if I'm wrong. So that's just basic. Yeah, that's exactly what I got from the whole. That's what I learned today, and I'm very appreciative. And I would want to say thank you. If you're not yet a member of EAYF, I think you should be a member, because I mean, this is exactly what we do. This is how we move ourselves from point A to point B down to point Z. If you notice, the hosts, the organizers, the speakers, we are all young. So, I mean, there's no need to fear. Please feel free to buzz me. Feel free to buzz Jude. If I don't know, I'll direct you to Nicholas. I mean, you saw his presentation, man. I don't need to tell you. So, I want to say thank you, and thank you, because we've come to the end of this webinar. I look forward to meeting all of you again. Sorry, Jude, thank you, speak.
Yeah, I just wanted to add some few words to what you said. Thank you very much, Joel.
Yeah, you're welcome.
Really helped us today, kept the session interactive. I also want to thank everyone that came out to join us too, especially Nick and Luther. Thank you guys for taking out your time to be with us today and share your experience. This was a very nice presentation, and hopefully we're expecting 1 million views on YouTube when we post it on YouTube. And just as an addition, guys, please, we are going to be sharing a survey form after the end of this event. It's very important that you please try and fill it out to help us to improve our delivery style, because we normally do it for all our events. And also, good news, all participants will be receiving a digital certificate for attendance. It will be sent to us, included with this email as well. And then, of course, a link to the recorded video will also be shared. So in case you missed out on what was being said, you can always watch the video again and then gain some insights. Thank you again, guys, and thanks for joining us. Joel, have the floor.
Have a nice day, everyone. Have a nice day. Later.
Thank you.
Bye.
All right.
Thank
Thanks.
you. Bye.
Yeah.
Bye.
Bye.
Yeah.
Goodbye.
Yeah, goodbye.
Bye.
All right. Thank you, Lota. Thank you, everyone. Cheers.
Cheers.